2023 housing market is going to be like no other. I actually think both buyers and sellers are going to be pissed because the market is so different. We're going to have this conversation with Lance Lambert, Fortune editor, who is all things housing. How you doing, Lance?
Yeah, doing good. Housing, housing, housing. Always a lot going on.
Yeah. When you talk about the housing market, or when I try to help people understand the housing market, there are lots of individual components that work together that tie into a big present. So I thought we should just go through the latest and greatest. You up for that?
Yeah, let's hit it.
So the first thing I think we should talk about is inventory, right? As I understand the national picture of inventory, inventory is up year on year, but new listings, right, week on week or month on month are down. Do I have
Yeah,
that correct?
that's right. Yeah, year over year, new listings are down about 20%. So the total coming on the market. And then inventory's up around like 40% year over year. And that's really been driven by demand pulling back. And so listings staying on the market longer. And if you roll over into the next month, that builds up inventory even as new listings are declining.
Absolutely correct. And again, because I look at this stuff all the time and I have a channel that is national, I think people need to be suspect of inventory because I think there's two things happening. One is being reported and the other isn't. So as of yesterday, I shared the fact that the luxury housing market has 163,000 units on the market. Now, luxury is defined very, very differently in different markets. I generally call it 2x the median homes. But it is no question that the high end of the market is being hurt the most. And thus, we are seeing markets like Orange County, where luxury is 2 million plus, very quickly explode days on market to almost 100 days, according to a local agent. So when we look at national housing statistics and we say we're up 40%, realize that the luxury portion of that market is distorting that higher. Is that reasonable?
Yeah, that's right. And that's it, it always is going to be longer on the luxury side, but that's really going to be the case in this environment heading forward as some of those buyers really, kind of stay hopeful to get as close to that, peak price tag as they can. And yeah, there's just a lot of patience they're going to have because not only, there's a spiked mortgage rate piece of it, but there's also the fact that the stock market, what the S&P 500 is down 30%, and a lot of these tech stocks are down even more. So there's definitely a hit to luxury.
Yeah, luxury is a want. If you're fortunate enough to be a luxury buyer, you don't have to, right? It's not a need. You probably already have a house or two, so it's definitely a want. And if your stock portfolio is down or your small business is not doing as well, you're not going to pony up for that. So again, the luxury market is distorting some of the metrics. Also, I will say that the luxury market is distorting price reductions because you're hearing more and more people talk about, oh my God, did you see this house have $100,000 price cut? Well, folks, it was 3.2 million to start. So 100 grand is like 2% or 3%. So, uh,
There's another point there, which is a lot of the housing bears like to point to the fact that this pandemic housing boom probably had some type of pull ahead effect on demand. And I think
sure.
where that's probably the most right is in second home and vacation home markets.
Agreed. I agree
Where it's like
1000%.
maybe weren't going to even get that for 4 or 5 years, or maybe never went out and splurged during the pandemic. And so those segments are just going to be hit a lot harder and have been hit a lot harder.
Yep.
Than
Luxury, second
say,
homes. Hmm.
yeah, than say, a well-priced home and, a good school district that's, the very middle of the market. There's going to be a
Yep.
difference there between
So
those two.
if you come down the housing inventory, and again, I want everybody to look at their area and their market. We're talking national. Lance has the purview. I have 20 years of looking at this. So luxury we've talked about, but I think the most surprising metric and why I was confident months ago calling 4 million transactions is the move up market, right? There are a large percentage of buyers who would like to upgrade, or an upgrade would be a natural part of their evolution, that simply won't, right? I think we're going to see the average tenure of homes, which used to be 8 years, over the next several increase as people decide to, upgrade in place. And because they're willing to get a 20% larger mortgage, but not 100% larger mortgage. And when you kill the move up market, you really do take two transactions off, right? You take the sale of one home and the purchase of another. And there are a lot of people with wish pricing that would love to sell the home they bought, but they won't sell unless they get their number. I talk to agents almost every day, right? We have a lot of inventory, and some people guess, like Sacramento, I talked to a number one agent there. Seattle, I talked to a number one agent. They're estimating that 25% of their listings are fake. I define fake as if they get their number, they'll take it, but they're not dropping it a penny. So that's why another reason you're seeing days on market extend out is you have wish pricing with no adjustments. So there, it's not really, is it really a listing? Well, of course it counts, but it's just going to, it's an expired listing at the 90-day or 180-day mark. So there's a lot of listings today that aren't real, in my opinion, because the seller just has a wish number and they're not going to take a penny less.
Yeah, I think that's very possible. And it still goes down to the fact that you kind of got to know who the seller is if you're going to get some deals out there.
Do the
Obviously,
work, man. Got to do the work.
Obviously the iBuyers, but knowing if it's a motivated seller, do they have a relocation? All of those things, a divorce could play into it.
And then finally, we get to the part of the market that I think has been underserved for years: FHA, VA, first-time home buyers. They were run over the last 2 years as cash buyers and investors, frankly, overpaid. But that part of the market is still there, right? And I'm seeing firsthand that the stuff 75% of the area median, right? So my market's 400 grand, Fresno, California. Anything around the 300 mark, selling quick, out the door. And oh, by the way, home builders can't play there. We'll talk about KB Home in a minute, but there is one part of the real estate market that's still hot that I think keeps a floor into the market, and that's first-time home buyer. Are you seeing some of that out there?
Well, we've seen every category of buyer pull back sharply, but the one that's pulled back the least relative to the others is first-time buyers. And that makes a lot of sense. For them, they're getting gouged by rents.
Yeah, exactly.
Went up a tremendous amount during the pandemic. And so there's more of an incentive to try to buy. And I think for some of them, believing that mortgage rates could come down in the future and be able to refinance. But yeah, so there's first-time buyers have actually pulled back less than investors and second home buyers and move-up buyers.
Yeah, if you look at the NAR report, which comes out monthly, which I'm sure you do, the first-time home buyers, I think, jumped 4% month to month, like from 23 to 27%. Now, some of that is volume going down, obviously, right? Because it's just a percentage. But there's a lot of stuff going on, and I would challenge folks, there's not one housing market. There's not one housing market even in your area. Simply said, there's luxury, move up, and first-time home buyers. Let's move on to home builders. Home builders have been targeted by lots of folks kind of saying, hey, see, it's over. All the pain. Look at the discounts. They're going to go out of business. And lo and behold, KB Home just reported earnings yesterday. They still earned over $2 a share. They missed expectations. Their backlog went down 25%. Their cancellation rate is 68%. Their net orders was like 650 or something like that, some small number. So again, home builders are doing exactly what I expected them to do, but I think it's going to surprise a lot of people that they're not losing money hand over fist. What'd you see in the KB Home report?
Yeah, I'm going to share my screen if I can.
I need to give you access to do that. Now you can.
Okay. Yeah. So this morning I had a piece go up on fortune.com looking at, the Fed's ongoing housing reset. It sees buyer cancellation at one of the largest home builders, spike 68%. And what we've seen is what you just said, which is that, KB Home, one of the nation's largest publicly traded home builders, reported a buyer cancellation rate in the fourth quarter at 68%, up from 38% in the previous quarter. And, they've acknowledged that current conditions remain challenging. High mortgage rates and persistent inflation, together with an uncertain economy, have made home buyers more cautious since the middle of last year. All of this we know, but it is interesting to see it. 68%, that's quite a number for the fourth quarter. But
it is.
Like the chart notes, it's a mortgage rate shock, a historical shock, really going from 3 to 6% right after a run up of 40% in home prices. And their strategy to work through this backlog is pretty much what you just pointed at, and that everybody knows, which is you turn to mortgage rate buy downs first
Yep.
and prices second. And the challenging bit with prices is, and this is something KB said on their earnings call, why they're hesitant there. It's not just about lowering the comps for the communities, it's that everybody who's already bought, if they know that prices are going down, they're going to come back to you and be like, hey, can I get a discount?
Right.
And so they're kind of trying to, balance that. And it's going to be a balancing act for the next 6 months, is what Ivy Zellman has said. And there's going to be downward pressure quite a bit on new home prices in the first half of this year as builders work through this historic backlog that really grew because, one, the supply chain issues that kind of held them back from building as fast as they would have liked to, and the worker shortages, but also, they got a little zealous. They sold a lot of homes during the run up. And so now, as they kind of work through that inventory in the pipeline, both single family and multifamily, and really multifamily is the bigger issue.
I agree with that. Yes. Yeah.
And and another thing is, the Bank of America said is that one of the reasons KB is so high is because 62% of their communities are out west and Mountain West. And so that explains it. And Bank of America in their note yesterday said of all the builders, they're the one
most exposed to the West. Yeah.
Yes, exactly. Most exposed to this correction.
Correct. Yes. Right.
And here's another look at the mortgage rate shock. It's the biggest mortgage rate shock in 40 years. And you can pretty easily tell right here how this is a different type of story than the 06, 2012 story. This is kind of more in the late 70s, early 80s shocks that we saw. And, right now with the mortgage rates, pretty much what all of the builders and agents and brokers are rooting for is just financial conditions to continue to loosen and mortgage rates to continue to fall. As we get favorable news on the inflation front, it does kind of look like recently we've started to see inflation fall a little more in the Mark Sandy outlook than the Larry Summers overheated. We're going to have to have 3 years of 6% unemployment rate to get out of this.
Yeah, I would agree with that.
And that is good news for the industry. Although somebody like Zandy sees, a short-term home price correction, going through this and not having us in a long-term period of very, very tight financial conditions is going to lead to more transactions if we can loosen the financial conditions.
Well, I think there was another number. I don't know if you have in this report. And again, I looked at the KB Home report. Did you by chance highlight their average home price, which I think was 510 grand, was up 13% year on year? I don't know if that's in your.
But the average is up year over year,
which I didn't expect, right? Because again, I expected them to be slashing prices. Now, in fairness, I don't know how they
slashing prices.
Yeah, I don't. Yeah.
They're out in the part of the country that a lot of those were up 25% year over year. So how did we get from 25 to 13? Was it drops or was it just as we kind of moved ahead in a deceleration? I'd have to look at the numbers.
Yeah, the other thing I just want to highlight, because again, I don't want to come off as a bull. I'm not a bull here. I think the year is going to be boring and flat. I think one of the problems with how KB Home reported that increase is they reported a top number, not a net number. What I mean by that, they may have reported a $525,000 sale, but then had 20K in credits or something below the line. So I think there may be some funny math in how they're calculating. I don't know that for sure.
Those builder margins are going to normalize. The pandemic margins, that's just not going to stick around. Now, here's the home builder stock performance. As you can see, we've actually gone up since the June to October bottom for most of these builders. And, DR Horton and Lennar are far above the S&P 500 performance for this decade. KB Home, you can see that they're kind of the laggard.
Yeah, one per second.
But it's certainly while builders are kind of reeling from this correction and the Fed's housing reset, it's hardly a doomsday for them.
Now
And
you know why that is, obviously,
I,
or at least
I
why
want
I
to give
think it.
you Bank of America's thoughts here.
Okay, perfect. All right, let's
Bank
do
of
it.
America's thoughts. Okay, so we're we are cautious on housing demand, meaning they think it's going to continue to kind of be weakened, but we see a more favorable setup for home builder stock performance, says Bank of America. Reason number one, home builder valuations are already pricing in weak demand and home price depreciation. Two, mortgage rates have declined from peak levels and are poised to move lower in 2023.
Yep.
Three, we do not see a material risk to builder book value. Most of the land on balance sheet was purchased prior to 2021, and we expect a home price correction, they think down 10% peak to trough, rather than a crash 15 to 20%. Builder margins will benefit from lower input costs. We estimate a 2 to 3 percentage point tailwind from lumber is what they're saying. So material costs coming down, home prices won't fall that much. And I also don't know if that 10% is new home, existing, or both. They didn't say. So home prices won't fall that much. Lumber is a tailwind and some of the other building costs. Mortgage rates are down, and the market's already priced this in. Is essentially what they're saying, and they're sticking with a neutral rating for KB, although they upgraded 3 other builders yesterday.
Yeah, and I think that has a lot to do with their exposure to the, I don't know, call it Mountain West. Oh, there it is, West Coast, Mountain West.
Yep. Has the highest risk of write downs. Yep,
sure.
Of all the builders they cover.
Yeah. And then again, when you tie stock market into the housing market, the stock market is obviously a forward-looking indicator. Most of the time when you look at stock markets, they're not pricing in today, they're pricing in 2 quarters from now. And I think what they're saying is interest rates will be down in 6 months. Maybe not materially, but down. Maybe we'll be sub 6. I think they're saying that the unemployment rate's not going to skyrocket. And then again, I think the other thing that I think a lot of people are missing, and this goes to my kind of final point, is I think a lot of people talk price, inventory, but there is a third component I'd love to wrap with you about, and that is demand. We talked a little bit about demand in the luxury or second home market, but I think we need to talk about demand at the kind of entry level homes, first time home buyer homes, millennials. Right. There's a lot of talk about this being roommate generation or going back with mom and dad. And I think if interest rates continue on a downward trajectory, there's no future spike. As wages increase, again, I believe in one of the ways that housing is boring for the next 3 to 5 years is wages continue to increase. And again, wages are distorted, right? The lower end, we've seen the lower end worker get the largest percentage of bump, right? 10% in service areas. While white collars is a bunch of layoffs in finance and tech. I don't think a lot of people understand that if you get multiple years in a row of 5, 6, 7% wage inflation, that just naturally makes homes more affordable. I think a lot of
the Fed has said that the level we're at now, the 5-6, is too high. They want it 2-3.
They do, but again, let's have that conversation.
Yeah.
The Fed is talking the entire picture.
So this brings up a good point, which is that housing had a really good setup going into 2020, right?
Sure.
Like these should have been all really great years for the housing market. The 5 largest birth years for millennials. And while millennials are known as this really big generation, which is 1981 to 96, it's really the middle part of it. It's 1989 to 1993. And those are the 5 biggest birth years. And every single one of those years in between 2019 and 2023, everyone in that 5-year period will hit the age of 30 between 2019 and 2023. So you have the biggest part of the millennial cohort moving into the first time home buying years.
Mhm.
And the housing market was just set up really, was put in a really good spot. And then of course you have the pandemic hit, mortgage rates go so low, there's an increased demand for space, while all of these demographics are there and inventory has gotten so tight, and it's just this perfect storm. And now we're kind of in this, kind of coming out of that, and there is still this demand there, but there's just such an affordability crunch, or what I call pressurized affordability, that's kind of sidelining that demand.
I agree.
So
I love that. I love that title that you put out. I saw you put that on Twitter the other day. I think that's exactly what's going on. And you can fix that over time. That's why
yeah,
I keep saying
like you
housing's
said,
going to.
wages rise.
Yep.
Now, this is the part maybe, bulls and bears debate, but maybe prices fall some, and mortgage rates being the biggest, right? If they can go down, if mortgage rates could go down under 5 or under 4.5, that's a very different story.
Oh yeah.
Um,
I mean, I'm not calling that's, I mean, anything is possible, right? It's all about probabilities. I would love to see it go sub 6. I think sub 6 is a game changer according to agents, because that's when the market broke in, was it June or August when it hit 6 the first time? And then it came back and they saw a little reprieve. So I think 6 is a magic number, because then you do buy downs and all that, you get sub 5. I think that's game changing. And again, all I'm worried about is marginal demand.
yeah,
When you're only doing 4 million transactions and 25% of transactions are cash, and then there's second homes and foreign buyers and investors, you don't need a very big pool of marginal buyers attracted to
yeah,
put that floor in. And again, remember, first time home buyers and millennials, they're not buying luxury homes. So that market's screwed. They're not move up buyers because they don't own a home yet. It is all that entry level stuff that I think puts a floor into the market. FHA, VA, 3.5% down, 0%. I think people are going to be shocked that inventory still stays tight, and thus prices are firmer than most people expect.
I see it a lot like a high jump, right? Like, let's say this is a track meet. Right
Okay.
now, they essentially started the high jump out at the very top, right? Like,
Mm.
and very few can get over it,
Yeah,
right? The
very few.
time
I
comes
like
down,
that.
more will jump, and there are people to jump. Uh, uh '09, there was no bar, and there
No,
was
there
nobody
wasn't a bar.
coming in.
Nope.
And
Yeah.
so it's
They didn't even show up at the track meet. They were at home and like, I'm not coming.
yeah, yeah, they overslept. So
Yeah.
two very different stories, and I think for a longer term market, I don't think it's the worst place to be in, going through a correction where that there is demand out there, but affordability is just too pressurized for them to get in, and you don't have to worry about an oversupply of the market. At least according to everyone from Bank of America, Realtor.com, who thinks there's a really big housing shortage, to people like John Burns, Real Estate Consulting, and Moody's, and Zonda, who think it's not quite as big, but still fairly big. Pretty much everyone thinks there is some type of structural housing shortage. So some type of shortage, good demand, but affordability is just too high. It's not the worst position to be in for the market. And I'm talking about people who just work in the market.
Mhm.
Although we are going to see a lot of them leave.
No.
Anybody on the transaction, a lot of people on the transaction volume side.
Yeah, I mean, when you build a business that's used to 6.5 million and suddenly you're at 3.9 or 4, that's a very different cost structure, and we're already seeing kind of all of that. I look forward to having these housing conversations. You do amazing work for Fortune. If somebody wanted to follow you or read your stuff, how would they do that?
Yeah, at News Lambert is where you can find me on Twitter, where I'm, constantly covering this housing correction, housing recession, this process to normalizing, whatever you want to call it. Or you can Google me, Lance Lambert Fortune, and find my article page at Fortune.
Lance, thank you for all you do. Amazing week. Take care.